Let's get to the big story breakdown. Well, Wall Street is eyeing a mixed open this morning after inflation figures and as earnings season kicks off. The first week of 2026 and the second week of 2026 also has seen new records for the Dow and S&P 500. Well, this week did get off to a bumpy start, but all-time highs continue for the Dow and the S&P. The Trump administration's investigation into Fed Reserve Chair Jay Powell prompting sharp criticism from former Fed and Treasury leaders and concern from investors. Well, joining me as we head into today's trading session is Michael Reinking, Senior Market Strategist at the New York Stock Exchange. Good morning, Michael. Thank you so much for joining me.
Good morning, Remy. Thanks for having me back.
Well, it's hard to believe it's only the second full trading week of 2026 with so many headlines. But what do you make of the records for the Dow and S&P 500?
Yeah, well, one thing we can take away is that, the Washington was ready to go right out of the gate this year. And, as you pointed out, there's been just a ton of headlines, creating a little bit of volatility under the surface at the single stock level, right? But broadly, we're continuing to see kind of equity markets kind of moving higher with the expectation that we're going to see kind of very solid earnings growth this year, kind of the economic backdrop with some kind of some fiscal impulse, kind of helping to drive that, right? And now we're starting to see kind of some of the headline risks kind of start to show up, right? Kind of we had the headlines with Fed Chair Powell that you just mentioned yesterday. Look, I think on that front, there was some bipartisan support for Chair Powell. Markets largely took that, kind of those headlines, kind of in stride, right? If you think about, what that could mean to markets, right? We didn't really see Treasury yields moving significantly. We didn't see this big steepening of the curve that everybody was concerned about, right? And that's partially due to the response that you'd seen. And we've seen that, there's not broad, it's not kind of fully supported within the administration, right? There's kind of some folks in the administration that don't necessarily support kind of this chain of action, right? And so I think markets took that in stride, and that comes out on the heels of what we had kind of in the week prior with Venezuela and some of the other situations around the globe.
Yeah, and absolutely no shortage of headlines to monitor for us. But of course, economic data and earnings in the spotlight this week. So This is the first time you're on since that jobs report from the end of last year. And there are also non-farm payrolls revisions coming down the pike. So what did you make of that data point in terms of non-farm payrolls, the unemployment rate coming down, and also this morning's CPI?
Yeah, so I mean, in terms of the non-farm payrolls, right, I mean, the numbers were largely in line. If you look beneath the surface, right, the job gains weren't necessarily coming from your cyclical sectors, but it continues to point to this kind of labor market that has been slowing. We did see the unemployment rate tick lower, but that was kind of partially due to the labor participation, right? So not necessarily kind of that there was just extraordinary job gains that were pushing that lower. This morning's CPI data also largely in line with expectations. We did see kind of an initial move higher as we saw the core numbers a little bit better, right? But I think coming out of the shutdown, right, the data has been so kind of sloppy, right, that markets really need to see kind of that data start to normalize over a couple of months, right? Because just the base that we're looking at for CPI and for kind of the look back in terms of employment, right? You can't necessarily trust all that data, right? So markets want to see some normalization, see kind of be able to understand where the trends are for a couple of months, and if you look at how the response, right, there was a very little response this morning, right? You didn't see any shift in terms of expectations for kind of for Fed rate cuts, and in fact we've started to see kind of markets push that out a little bit later in the year, right? So January is pretty much off the table, and then you've started to see markets start to price in the first cut closer to April, maybe June. Kind of up from back from March, right? So markets are kind of taking the data in stride, but wanting to see some normalization.
Yeah, and finally, before I let you go, earnings season kicking off with JP Morgan reporting results earlier and with big banks coming down the pike in terms of results this week as well as in tomorrow's session.
Yep.
But of course, when it comes to the earnings call, given the way that we've kicked off 2026, I'm sure you and I will be listening closely to the outlook coming out from the big banks. But what do you think is the key takeaway from JP Morgan, and what are you looking for this week?
Yeah, so look, I mean, the JP Morgan number is pretty strong. There was some weakness. They had a little bit of a miss in the investment banking side, which is kind of surprising. I'm not sure how much of that was related to the government shutdown and potentially pushing out some of that activity, kind of into Q1. That conference call is ongoing, so I haven't heard some of their commentary on that. But in general, right, I did see some of the headlines from their CFO kind of talking about consumer spending. Kind of credit markets all seem to kind of look kind of pretty steady state. And even Jamie Dimon's comments in the press release, kind of a little more optimistic than he has been over kind of much of the last year. In terms of earnings, right? I mean, the earnings expectations for the year are very kind of calling for kind of mid double digits earning growth, kind of across market capitalization, right? There's this expectation that you're going to see earnings growth start to expand beyond just your kind of technology companies, right? And so I think that's going to be kind of, I think what I'm looking for in this Q4 reporting season, right? Because we had this, we had the government shutdown. The environment didn't really shift so much, so I don't think you're going to see kind of all that, these big surprises, right? But I think the most important thing to look for is kind of price action, right? So we've seen quite a few technology companies pre-announce. We have to see, kind of as those companies put up very strong numbers, how do the markets respond? And then on the flip side, right, where we've seen this rotation, the rotation into kind of more cyclical areas of the market, we haven't seen the fundamentals there turn yet, right? But as we start to see kind of companies talk about what they expect in the year ahead, and if the numbers are kind of a little bit softer, how do markets respond? We've seen a couple of chemical companies recently kind of miss numbers. The stocks gapped down, but immediately were bought, right? So kind of investors have been using kind of some of that weakness to kind of get involved and kind of increase exposure to some of those areas of the market. So I think the big thing for me this quarter is really just kind of is kind of the price action and seeing how markets respond to kind of both bad, good and bad news.
Well, Michael, I think that's important to keep in mind as we head into earnings season. So thank you so much for breaking all of it down today.
Thanks for having me. See you next week.
Thank you.